I just can't handle the day-to-day ups and downs of the stock market.
I'd rather play it safe with low-risk options.
When the market goes up, I wonder, am I missing out?
I'm not sure I can go back into the market without some kind of assurance.
The unpredictability and volatility of equity investing can be difficult to take. Yet investing in equities may be essential to reaching retirement needs and goals. So the question is, how can investors participate in upside market potential while staying protected from some of the downside? AXA Equitable has an answer. Structured Capital Strategies offers participation in potential market gains up to a ceiling, meaning the ability to track an equities or commodities index up to a determined performance cap rate, depending upon the investment you select. It provides a structured growth strategy through a segment buffer, a built-in protection feature in which AXA Equitable will absorb up to the first -10, -20, or -30% of any loss, depending upon the investment you select. You will absorb the loss in excess of the segment buffer. And it has flexibility and choice. All because AXA Equitable is committed to helping you with your retirement planning and investment goals. Structured Capital Strategies is a variable annuity, a long-term financial product designed for retirement purposes. It is a contract between you and an insurance company that lets you accumulate assets through investment in equities and other investment options with the benefit of tax deferral. You may then take payments or lump sum amount at a later date. There is also a death benefit that returns the account value, if any, to beneficiaries. Tax deferral offers great advantages. In the present, because you keep more of your current earnings by saving with before-tax money. And over time, because you pay no taxes on your investment earnings until you withdraw your funds later. So your earnings have the potential to compound year after year and help your savings grow. With Structured Capital Strategies, you can choose to invest in the structured investment option or in variable investment options. We will be focusing on the structured investment option, which I will explain shortly.
Can I get by without investing in equities?
Historically, over the long term, equities generally offer the best chance to increase assets and address inflation concerns and income needs for retirement. That's why AXA Equitable designed Structured Capital Strategies, a tax-deferred growth strategy that provides investment performance that is tied to one or several equity and commodity markets, while easing some of the losses associated with short-term volatility. The structured investment option permits you to invest in one or more segments, each of which tracks the performance of an equities or commodities index for a set time period, up to a performance cap rate. In all, the structured investment option offers 15 segment types or choices, so you can structure your investment to match your personal goals and risk tolerance. The overall investment option you choose is called a segment type, and is defined by the segment duration, the segment buffer, and an index. Your segment is your investment, generally beginning on the 15th of the month and ending on the maturity date. The segment duration spans over 1, 3, or 5 years, running from the segment start date to the maturity date. The segment buffer is a built-in protection feature in which AXA Equitable will absorb up to your choice of the first -10, -20, or -30%, depending upon the segment type you select, of any loss, and you will absorb any loss in excess of the buffer. You have a choice of 5 indices, available depending upon the duration and buffer you select, including the S&P 500 Price Return Index, Russell 2000 Price Return Index, MSCI EAFE Price Return Index, London Gold Market Fixing Limited PM Fixed Price in US dollars, known as the Gold Index, NYMEX West Texas Intermediate Crude Oil Generic Front Month Futures, known as the Oil Index. Segment types with greater protection tend to have lower performance cap rates than other segment types that use the same index and duration, but provide less protection. Please keep in mind that any or all investments are subject to market risk, including the loss of principal.
Is Is there such a thing as protection for market downside?
Structured capital strategies helps investors get back into the market with confidence. The segment rate of return is equal to the performance of the index, subject to the segment buffer, but not exceeding the performance cap rate, which is the maximum potential ceiling on what you may get from index gains and is set by AXA Equitable. Neither the segment rate of return nor the index performance is an annual rate of return. They are measured from the segment start date to the date of maturity. Keep in mind, you will not know what the performance cap rate is until the segment starts. Segment types with greater protection tend to have lower performance cap rates than other segment types that use the same index and duration, but provide less protection. Here's a hypothetical example of how a specific choice of segments would work. Let's say you choose to invest in the S&P 500 for 5 years with a 20% buffer and a performance cap rate set at 17%, the maximum you can get from index gains. If the S&P 500 goes up by 15%, your segment rate of return goes up by 15%. If the S&P 500 goes down by 20%, your segment rate of return doesn't go down at all due to the 20% buffer absorbed by AXA Equitable. If the S&P 500 goes up by 20%, your segment rate of return goes up by 17%. If the S&P 500 goes down by 25%, your segment rate of return will only go down by 5% because you chose the 20% buffer. Now that you have made your selection or chosen your segment type, let's look at the life cycle of your investment. Your money goes into the holding account until the segment start date, generally on the 15th of the month, when it is invested and the performance cap rate is set. Your investment continues for a period of 1, 3, or 5 years, depending on your chosen segment maturity date, when the segment ends, and you can reinvest your money into the same or a new segment type or one of the variable investment options. At any time before maturity, the value of your investment is called the segment interim value. In case of surrender, cancellation, or withdrawal of funds for any reason, the segment interim value might be negatively affected. For example, the segment buffer might not apply to the extent it would on the segment maturity date, and any upside performance would be limited to a percentage lower than the performance cap rate. Also, the earlier you withdraw, the lower the segment interim value would be. Participation in upside performance for any early withdrawals would be prorated based on the period those amounts were invested in the segment.
Why AXA Equitable?
Financial protection has been our guiding principle for over 150 years. AXA Equitable is part of the global AXA Group, one of the world's largest financial services organizations, and a global leader in financial protection strategies and wealth management.
Now is the time?
Now is the time. You don't want to miss out on participating in potential market gains when saving for the long term. Structured Capital Strategies gives you a smart and innovative way to get back in the market. Structured Capital Strategies, a tax-deferred growth strategy, allows for participation in the upside performance potential of indices and protection against certain down markets, with AXA Equitable's long track record of helping individuals for over 150 years. This video is not a complete description of the Structured Capital Strategies variable annuity. You should always consider the charges, risks, expenses, and investment objectives carefully before purchasing a variable annuity. The prospectus, which contains this and other information about structured capital strategies, can be obtained from your financial professional. Please read the prospectus carefully before you invest or send money. AXA Equitable has sole responsibility for its annuity and life insurance obligations. Your segment rate of return is limited by the performance cap rate, which may be lower than it would otherwise be if you invested directly in the applicable index. There is a risk of substantial loss of principal for losses beyond the segment buffer, because you agree to absorb all losses to the extent they exceed the protection provided by the structured investment option at maturity. You are protected from some downside risk. If the negative return is in excess of the segment buffer, there is a risk of loss of principal. If you would like a guarantee of principal, AXA Equitable offers other products that provide such guarantees. There are fees and charges associated with structured capital strategies, which include a contract fee that covers administrative expenses, sales expenses, and certain expense risks. There is also a withdrawal charge on underlying variable investment portfolio expenses. AXA Equitable Life Insurance Company has sole legal responsibility to pay amounts it owes under the contract. Any obligation owed in connection with the structured investment option is backed by the claims-paying ability of AXA Equitable.